One of the biggest advantages of planning is that a trader is not really caught by surprise for whatever the market throws at them. This preparation is what triggers good trading behavior. Planning is very critical. In fact, the importance of planning cannot be understated for any trader, regardless of their trading style, be it positional, swing, day trading, scalping, anything. But it is my view that shorter the trading time period or sharper the trading style, greater the importance or relevance of planning is for the trader. This view is because we know that volatility is inversely proportional with time, or lesser the time, greater the volatility, and vice versa. Since day traders and scalpers are trading for very short durations, they are the most vulnerable to intraday market moves and intraday volatility. Therefore, it is very important to come with a clear plan a day in advance before you actually start taking the trade the next day. The biggest importance of coming up with this clear plan is actually not just that your capital is maybe perhaps protected or that you execute better trades. That is, of course, one of the key reasons why one needs to come up with a trading plan. But in my experience, the reason why a trader needs to develop a trading plan is to prevent trader burnout. Experiencing or allocating a lot of money in a very volatile environment where changes of thousands of rupees is just a few hours away can be incredibly tough, and if sustained for a very long duration of time, trader burnout is a real thing. So coming back to the chart that we have in front, currently what I have is the price action of Nifty as of yesterday. We were seeing downward sloping moving averages, and we had clearly established that with a death crossover and downward moving sloping moving averages along with ADX above the value of 25, this is a security which needs to be sold. And to sell a security, we need to sell the rise. But before we can implement any sell plan, we obviously need to determine the exit plan first. And the hypothesis of the sell plan for the next trade session, which happened today, was that 1 ATR above the 50 period moving average would be the exit call for this plan. We can see that the 50 period moving average is approximately 22,350 and that the 1 ATR on closing was approximately 75, giving us a plan exit of 22,425, which means that if the market traded at this level or above at any point in time, the trader would no longer maintain the sell bias that was carried a day before. And a trader needs to do this because while creating the bias, we do not know what is going to happen in the future. We have to be prepared. What if there is an unprecedented gap up? What to do then? And what if there is a gap down? What to do then? The plan has to be very clear. So here we'll see that the market clearly opened above the planned exit, implying that there would be no sell positions for the day. In fact, since the previous day the price action was trending downwards, there will certainly be no buying positions in the day either. And we had already factored that if the trend changes, that is, if the market trades above our trend changing level, then the market will most likely begin to range. And this highly oversold market could rally up higher to meet the moving averages on the daily charts. So let's see how the day progressed. After the gap up and the sell, we see an hour of some pressure followed by a recovery rally in the market where it has closed right on the face of the gap. And as it closes, we can now see that the distance between the two moving averages is now becoming very narrow. In other words, if the market sustains this price even for the day tomorrow, it is very likely that we will see the 20 period moving average cross over the 50 period moving average on a bullish direction. But like I said, just because it crosses over on a bullish direction does not mean that this will be a trend. In fact, after a bearish trend, the first expectation or the first hypothesis has to be that the security is going to range. And if it is ranging, then we can see that the low of this range, that is 21,950, is the only thing that is confirmed. The high of the range is not yet defined. That is, the current high of the market at 22,550 needs to hold for at least 6 candlesticks decisively in order for us to establish the high of the range. Since I have already clarified that I do not enjoy trading ranges and I don't even recommend range trading for traders, But if one is still to trade the range, then the only potential plan could be to sell the 21,950 put. The deep OTM put basically means that your claim is that because this value is the range low, the market will at best create a double bottom but will not break this range low. And why are we saying that the market is likely to range? We are just waiting for the crossover of the 2050 moving average. That is something that we are waiting for, at which point we would know decisively that the market indeed is ranging. Additionally, if I simply set up the ADX setting, you will see that the ADX at the moment is still 29. We need to wait for the ADX2 to come below 25. But because the market traded above the level of what we would say is acceptable to us, we would now begin to assume that it is possible that the market could range. And we are only waiting for a confirmation on Friday for this. Since there is no plan to trade a range, at least from my side, there will be no plan to trade tomorrow. And one will have to wait to see where the market actually settles on the weekly close in order to determine the plan for the subsequent trade sessions. Obviously, a decision or a trade plan which means that no trade tomorrow seems to be very demotivating for the listener, because you would feel that what is the point of analyzing the market if we are not going to trade the market the next day. And this is where I would like to mention that while for the purpose of education we are discussing the Nifty 50 chart on the hourly, no one has stopped the user from doing this assessment on all the securities that are listed in the market to identify that perfect security that they would like to trade. But looking at Nifty itself, a security that is threatening to range with unclear range stop, and if I have traditionally defined a bearish week trend as a trend in which the market does not decisively cross the 50 period moving average, then today's closing is anything but. Market has decisively crossed the 50 period moving average, changing the trend structure from bearish week to now threatening to complete loss of trend. One would also question how is it that we could change our assessment so quickly within a matter of 2 weeks? And the answer is that is the nature of trading or analyzing the market on the hourly chart. This 1 to 2 week analysis, which has been on the sell side, is also an extension. Typically, the trend on the hourly chart will change every week, and a trader has to come up with a new plan for the subsequent trading week. For now, the range only dissuades us from continuing further, and we will let the traders on the longer time frame decide what is it that they would like to do. Let's just have a look at how the Nifty is behaving on the daily. On the daily, we will see that the market is still trending downwards, and the previous test of the market, as we can see here, was till the 50 period moving average on multiple points. And each time the test, duration, and the intensity of the break beyond the 50 period moving average has reduced. Market is currently priced at 22,520, and the 50 period moving average, the green line is the 50 period moving average. So all these tests were to the slower moving average, that's the 50 period moving average, and we can see that the 50 period moving average as of today is at 23,180. And because this value will change every day, we could expect that in a couple of days this is going to reach 23,000. So therefore 23,000 seems like a logical retest of the previous pivotal high based on what the market has done on the daily charts for some time. But if the market is even weaker than a bearish week market, then this faster moving average of the 20 period, which is currently at 22,800 and will reach a level of approximately 22,700 or 750 in a couple of days, will become the first resistance point for the traders who are looking at this market on the daily charts. Since market has another 200 points to go with nothing but a few gaps in between, we should expect the gap traders in the market to take a decision on this. For now, our trade plan, at least based out of the hourly, is simply to not participate in this market for now, and to look for more suitable chart structures with a clearly defined trend in order to decide where to move next. I hope this video has been useful for the purpose of planning your trade for the next day. Take care.